Welcome everyone. I'm going to give a few minutes for people to get in, get their volume and their sound, but welcome. Thank you everyone for being here tonight. We're going to have a full house. We'll let everybody get on.
Hi, Lori.
Hi. I see a lot of familiar names. It's good to see everybody. Thank you for those that have their cameras on. Hi, waving at you. Awesome. So Jeff, if you want to continue to admit people, I'm going to go ahead and get started and honor the people that have made it here on time. And I just want to welcome everybody to this wonderful Tuesday in October already. Like, where did the year go? I can't believe that we're here already in October. We have our November meeting, and then we do normally our holiday party in December. We're still trying to put something together where we can hopefully be together physically, social distanced with masks, but yet enjoying each other in person. So follow the emails on that. And looks like we have a few more people coming in. Hopefully you can see my screen. If somebody could just give a chat and let me know that you can see my screen, okay, that'd be great. Mark says, good evening from San Francisco, go Braves. Okay, yes, thank you everyone about the screen. Awesome. Well, I just want to hope that everybody is doing well. I actually was able to travel, which it's funny because I do quite a bit of traveling, and my kids had asked me, Mom, now when this coronavirus allows us to travel again when everything's open, are you going to travel double next year? Because you didn't travel at all this year. But I did get to go to Tampa, Florida, and I will tell you that it was actually really nice to be around people and to have the ability to go into a restaurant. I don't know if you've had that chance yet, but to go into a restaurant and have the energy of people around and be able to eat, that was actually really nice rather than sitting outside. Not that sitting outside is bad here in California yet, but yeah, that's what was fun. All right, so we're going to get started with the slides. As you know, we make no endorsements, warranty, or guarantee of any kind, and we do encourage everybody to perform their own due diligence before investing in any investment. And if you've heard me say it before, I always say, if you're gonna invest and make a profit, I'll let you keep it. And if you invest and you make a loss, I'll also let you keep that. So do your own due diligence. So our mission here is to provide education, networking, and inspiration necessary for you to make wise and profitable investments. What we really want to see you do is impact your life for the positive with your investments. And so we're providing all those opportunities as far as opportunities of investments, different tools, networking with each other, and data. Tonight we're going to talk a lot about data. So if you were part of the group a couple years ago, you know we did a survey. And we asked everybody in the room, you know, if they have done business with somebody else in the room or because of SJREI. And the great news is that over 78% of our regular attendees have done business together. And that's why we say SJREI are where the deals happen, because deals really do happen in our following. So I just want to tell you a little bit about the deals that are flowing in. In the past couple of months, we've had the opportunity to work on and negotiate several deals. And all of these deals here that I have up on the screen involve some form of seller financing. Now, I always think it's interesting when I tell people that seller financing does exist in California, and they tell me, no, it's such a hot market, you can't get seller financing. And I just want to show you here, not only have we gotten seller financing, but four properties that we're working on. Each one is a little different in the type of seller financing that we've gotten. So let's just kind of go through them. 2650 SoCal Drive. If anybody is familiar with Santa Cruz, this is over by 41st, and it's in the hospital district. It is the Silver Spur restaurant. Now you might say, a restaurant? Why would you buy a restaurant during COVID? Well, it was on clearance. So, we were able to negotiate a great price. It is an ideal location because of some of the development that's going on around the location. And we were able to obtain seller financing with a 20% down. We've got great terms on that. And we were able to find a person to run the restaurant. So we have turned it into a cash flow property. We are pairing that with the property that's right next door, which we also put under contract. And between those two properties, we will take them through entitlement and be able to build at least 40 single unit, like apartments, maybe 1 bedroom, 2 bedroom, mixed use with commercial. We are looking at whether or not to make it something like assisted living or mental health care. But at a minimum, if we get the 40 units with the mixed use, just the entitlement portion of it will be worth about 4.2 million. And so that allows us to make money just on taking it through entitlement, with the seller financing, with the rents coming in and covering our costs to hold the properties. So very low risk on those two. The next one, 21855 Hyannisport. This was a seller who inherited the property from her father and no longer lived there. It was in very serious disrepair, and she agreed to sell it to us for a specific price, but would allow us to go in, do all the repairs, and resell it to our end buyer without any payments or closing on it for 5 months. And so we will have until pretty much the end of December, and we have not had any carry costs. We have everything appropriately documented in escrow to protect ourselves. But again, this is a $2 million property that we're not having to service or do anything, and the seller was willing to work with us on this property. And then the last one, 2354 to 2356 Spelt Street. This is a 2-unit, like a duplex, that is part of it's being used as a vacation rental. The seller was very amicable to work with us and offered us seller financing on it. Again, so very little money that we're having to come in with, and we get to take over the property, add value, and then we'll be able to resell it later. So don't be afraid to ask for seller financing. It's one way to get into the properties with very little cost. You're not having to pay hard money fees to get in, which helps make more profit for you. So I wanted to share with you, I know that I've talked to quite a few people that have just set up quick consults with me, and I find that a lot of people are sitting on the sideline. They're waiting for the market to collapse so that they can go in and buy the deals. And I just want to tell you that when you're sitting on the sideline, it may not be the best opportunity for you. You may be leaving money on the sideline. And so we have different opportunities if you do want to do something that's somewhat short-term being 1 to 2 years, we do have a fund that is registered with the SEC. It's a 12-month placement, so you put your money into it, you can get it out 12 months later. It is secured fixed income, which means that you will receive a straight 8% on that, and then again, you can get your money back out a year later. Now, the nice thing about this particular SEC fund is if you're coming out of another property, like let's say you're doing a 1031 and you don't want to necessarily go into another property, you can work with us on this fund and 1031 into this fund. So that is one of the options if you're looking to go into something that's short-term and just secured fixed income. In addition, we have multiple development opportunities with Upside where we share that. Those development opportunities are typically 12 to 18 months. And we are doing rehabs locally. So we do have shared equity with those, and those are usually anywhere from 5 to 12 months. So if you're interested in that, make sure you reach out to me. The other thing I had mentioned, if you're doing a 1031, I just want to make sure that everybody knows that there is a program out there where you don't even have to do a 1031. And this is something we've talked about before, but I can do a private consult with your situation. If you want to sell your asset, you want to get the cash, and you want to defer your taxes for at least 30 years, set up a consult with me, and we can help you do that. So this is one of our projects that we've been working on for the past couple of years, and we are so excited about it. So in this project, you'll see on the right-hand side is the picture of Antique Row. And if you've been by this is on West San Carlos over by Santana Row. You probably recognize the building. In this particular area, the city has asked for increased density as they want to develop it as urban village. And so over a course of time, we were able to negotiate and assemble an entire block. And we have submitted our application to the city that will allow us to build. We'll be building 6 stories on 1.23 acres. It will allow at a minimum of 61 condos up to 83. And then the back side of it we'll be using for assisted living. The location is here, this blue dot over by the 99-cent store, if you're familiar with this area. We've got Santana Row on the left-hand side. We've got Santa Clara Valley Medical in the lower portion. And then we've got O'Connor up here. So we're centrally located, we're near the airport, it is a fabulous location. And this particular project is going to be a signature project. Like when you go down the road, you're going to notice it because of the size. So that's where we're at there. We've got O'Connor, Valley Fair and Santana Row, and Valley Med. So this is what it looks like. We were able to assemble with 3 different owners, the entire block between Brooklyn and Boston. And this is what we've proposed to the city. It'll be 6 stories on the front side, 5 stories on the back with underground parking. The main floor will have retail that is both open and accessible to the public and to the residents. This is from the other side of the street. And this is looking at the back where the assisted living entrance would go. So the exciting part is we submitted this with all the reports that we had, and we received back our first round of comments from the city and from all of the different municipality entities that have a say in it. And it came back as conforming. So just about everything that we had proposed was conforming. We do have a couple of variances we're going to ask for in regards to the setback for one of the areas that we're using for the cafeteria. but it really isn't that big of a deal, and everything else came back as conforming. And what that means is that it pretty much will allow us to get our entitlements. Now, why are entitlements important? Because when developers, the people who build it vertical, want to come in, they want to know that they can actually build it and nobody's going to stop them. And so by us taking the time to take it through entitlement, we add value to the land. And so we are in our last round of fundraising. This will be pretty much it. We're looking for 1.2 million. We've already raised 1.8. And we are going to offer an educational webinar coming up next Thursday. And I'll give more details on that. But here, here are some reasons why we like entitlement projects. You see that we're going to be doing that in Santa Cruz. Same thing that we did here. The reason we like the entitlement is because it's basically recession proof, in the sense that you can force the appreciation regardless of the economy. And most often during recessions, building costs go down. If building costs go down, that does not necessarily affect the value of the land. It can actually help you. And so they're usually short term. We don't have hardly any carry costs on these projects because we do negotiate with the sellers to wait for the purchase until after the entitlements are done. And so it allows us to get double-digit returns, and that's annualized returns. So if this is something that you're interested in, I would suggest that you go ahead and sign up for the meeting. We're going to have a meeting next Thursday at 7:30 p.m. And to register for the meeting, just head out to our development site. It's www.northpointdiversified.com, and go ahead and click to attend that. You do have to register in advance for this event for us to discuss this with you, and you do need to be accredited. Okay, so please go ahead and go out there. And I think that is about it for me. So
Lori,
do we have?
It's on the SJREI.org site.
Is it on SJREI? Okay, so it's also out on our SJREI.org website too. So you can register at either place. It'll get you to the same one. Okay, so do we have Aaron and do we have Sean? I just want everybody on here to understand the value that we have tonight, having the two kings, one of marketing, one of data, in the same call with us tonight. And so I'm really excited to be able to introduce and turn over the controls here to Aaron and to Sean. So hopefully they're here.
Yes.
Awesome.
Just finding controls.
Okay.
Looks like I'm on. Hopefully you can hear me.
We can hear you.
Great. So I will share my screen.
Yeah, let me unshare mine. All right, you should be able to share now.
All right, hopefully you
Yay!
have that. And I'm just going to move the videos so I can see everybody too. Fantastic. Well, thanks, Lori, for having us. I really
yes, thank you.
it. And yeah, I'll jump right in and keep things moving. I have a ton of slides, way more. Like my whole presentation is supposed to be a presentation on its own, but so we can fit Aaron in too. I'm going to go through it really fast, but I'm happy.
Well, Sean, didn't I tell you have until 10 o'clock? No, I'm just kidding.
Need a cocktail. Yeah, we hopefully won't go that long, but no. But I am happy to answer questions if there's time for that at the end. But I'm going to move pretty quickly, so buckle up, and we will make it happen. I'm going to move one more thing here. I'm on the road, so a little bit different setup than I normally have.
So Sean, I'm going to be here in the background. I'm just going to go ahead and turn my video off so that we can focus on your slides.
Great, awesome. Okay, so just a little bit about me. I'm a two-time college dropout, both times to start software companies. Had a little bit of early experience in real estate because I owned a Homes and Land magazine right before the Japan debacle, and it was in Hawaii, so we got hit pretty bad, and it taught me a lot about economic cycles and kind of made me an amateur economist, right? I've been very interested in that ever since. Then back to tech, 3 Silicon Valley startups, did really well, got rid of all my stocks in late 1999, which worked out really well, and then jumped into flipping properties from 02 to 05, and very fortunately exited in the first half of 2006. Started a company called Foreclosure Radar in 2007, which today we call PropertyRadar, and expanded. It still does everything we did before, but we expanded beyond foreclosures to cover all properties. So we do the foreclosures and monitor all the rest of the things going on in the real estate market as well. So what we're going to talk about tonight is the crisis cycle. And I gave a presentation back in 2016 where I kind of talked about this cycle and how I thought it was likely to continue. And I said, you know, that the next big event will be some form of black swan, and listed a number of those, including the possibility of a pandemic, and kind of said, here's what's going to happen. I'm going to walk back through those slides because I think it's just really important. Not so much that, okay, yeah, that's what happened, but it's what's going to continue to happen, right? Like, this is a cycle that we're in. It's going to continue to get larger. And once you realize that, then when something like the coronavirus or whatever the next black swan is, you'll know how to react and what to do and what likely will follow. And I expect this cycle to happen again, and we'll talk about that. So we're going to jump in the hot tub time machine. We're going to jump back to 2016. I'm going to walk you through the slides that I had then, and I think they still apply today. So I think the fundamental underpinning of today's economy is the great inflation of the 1970s, right? So here's a chart of inflation that went from 1.5%, 2% in 1965 up to 13% in 1980. And Carter came in, he brought Volcker in, you know, and I think they really tamed the inflation, but it cost Carter re-election, and a lot of people blamed him for a bad economy. I don't think he gets enough credit for the fact that every bit of our good economy since the 1970s, I would say, was due to him and Volcker. You know, Volcker's really aggressive rate action brought that under control. And in that, right, my parents in this time were building their dream home. And when they started construction, I think interest rates were 8.5%, 9%. When they finished construction and had to do the new loan to refinance their house, it was at 18%. And it came, and both my parents were teachers. My dad was a professor, and my mom was a middle school teacher, elementary school, middle school teacher. And it very nearly broke us. It was a very tough couple of years. But that high interest rates and kind of the elimination of debt set us up for a very long period of prosperity that I would say is a debt-driven economy. And really, we've had a debt-driven economy since 1982. Being in tech, and I know there's probably a lot of folks, given that this is in the Bay Area, a lot of folks in tech, you probably think you're responsible for driving a lot of the economy. And the problem with tech is, right, is tech makes the economy more efficient, but in doing so, we employ fewer people. And so I don't give tech very much credit for driving our economy. I give debt most of the credit for driving our economy. And as you can see, as interest rates have come down, we've taken on more and more debt. And this makes sense. You think about yourself, right? You can afford a more expensive house. Think about the markets right now, right? People are spending more on housing, because interest rates are lower, and so your payment is less. And so when on a given amount of income, you can take on more debt for the same amount of same payment, right? We tend to do that as a society. So kind of jumping forward, I'll skip the 80s housing crisis. We'll jump forward to 1999, right? We got the internet boom, pets.com, the Y2K bug, right? The cover of Time is getrich.com, right? And that's when I knew it was time to sell my stocks, which I did. And, you know, look at what's happened here, right? So we've had pretty good declines in interest, but when you look at key types of debt, right? Mortgage debt, corporate debt, federal debt, student loan debt, et cetera, right? They're all behaving reasonably well up until this point in 2000 when we have this crisis. And of course, we all know how that bubble ended. It ended with the tech bubble. And what did we do to rescue the economy from the tech bubble? But we grew a housing bubble. So fast forward to 2005, housing is booming. We've got low unemployment, federal deficits falling, right? Things are pretty darn good. At this point, I'd flipped 150 homes and couldn't have been happier. And kind of like in 1999, Time Magazine, Home Sweet Home, it's time to get out. And I did. In the first half of 06, I sold everything I had, which was a good thing because a lot of those properties were in places like Stockton, where I think the last property I sold in Stockton, I thought I would sell it for $320. I ended up getting $260, and in 2008 or 9, it sold on the auction steps for $45,000. Housing debt was skyrocketing through this period of time, really, you know, starting to slope upward faster and faster. And but we still look at this chart, we start to see a little bit of an increase, big increase in the housing, but not so much in others. Like debt's still behaving pretty well. Interest rates still coming down, right, into 2008. And I ended up on 60 Minutes talking about the foreclosure crisis and, of course, the housing bubble. This slide says 15 trillion. You'll see, because these are my slides from 2016, I think current estimates are closer to 13 trillion. You know, what's a trillion between friends? And, you know, then when I gave this talk, I said, look at 2016, right? The stock market's an all-time, unemployment's low, we've got soaring home values, but federal debt's nearing $20 trillion, right? And it's a little concerning. However, at that time, I did say I wasn't as concerned as I was in 99 or 2005, and that I thought this was likely going to continue until there was some sort of black swan, which I'll come back to. But boy, look how things broke in 2008, right? So we had debt all kind of behaving fairly nicely, interest rates coming down to support more debt, right? Kind of a good economic period. But in 2008, boy, did things break, and debt just starts to skyrocket. This top one here is student loan debt. If you're wondering why we're talking about student loan debt and why it's a problem, this is why it's a problem. It went from this kind of path to this kind of a path, and that's not sustainable, right? Same thing with federal debt, corporate debt, even housing debt, which got, you know, hit pretty bad, is up. It's actually now up above, this was 2016, it's now up above where it was in 2008. So kind of across the board, right? Debt kind of trended way upwards and faster than it had in the past. And I said at the time, you know, look, the next time we have something, it could be an everything bubble, stocks, bonds, real estate. Like that's, you know, what is this next thing? What's it going to look like? You know, it's hard to say at that time. And bigger picture, I was thinking about what happens when we hit the zero bound, right? So if we've got an economy that's driven by lower and lower interest rates, right? And what happens when we can't have interest rates go lower, right? Is it negative interest rates? What is next? What happens at that point, right? And some of the examples from history are pretty scary, right? The Weimar Republic, which led to Hitler. Weimar Republic went from a global leader to utter collapse, hyperinflation, massive civil unrest, and set the stage for World War II. Just to put in perspective, I don't think people realize what really happened there and what a hyperinflation looks like. Imagine a loaf of bread. This is pfennigs and marks, not pennies and dollars, but it's the same proportion, right? So imagine a loaf of bread today costing 13 cents and a few years from now costing $1 trillion, right? Like really sit and try to think about that and what that means and how hard it would be to feed yourself and how open you'd be to things like Hitler, right? Like that is a pretty massive shift. And I don't think a lot of people appreciate how big that change was. Fortunately, I don't think we're like the Weimar Republic, right? So I owned a Homes and Land magazine in the late 80s in Hawaii, and Japan had their debt crisis. And it was devastating for my business in Hawaii, selling real estate or advertising to realtors, because the Japanese, who were going crazy buying everything, stopped. And a lot of them went into foreclosure and had to sell, and nobody was buying. And it was pretty hard to sell real estate ads, I can tell you that. However, right, they didn't turn into Weimar Republic. What happened, right? Their debt continues to grow, and yet negative interest rates. It's really crazy. Dorian, I think your mic is unmuted. It's really crazy what happened there. And just how much it hasn't mattered, the amount of debt that they've had. Now, there's a whole bunch of reasons behind that, but I think we're actually in better shape than Japan. I think one of the reasons they didn't implode like the Weimar Republic, everybody was mad at Weimar Republic over World War I. And so they said, well, you guys are having trouble, you're on your own, right? Japan, like we buy TVs, cars, et cetera. Like you can't just let them implode. They were important to the world. We have the benefit of being the world's reserve currency, having the largest military, being resource rich, the center of tech, finance, and entertainment. Like, I think kind of like we couldn't just let Japan off into the abyss. I don't think the US will head off into the abyss, right? But I also thought maybe we're stuck like Japan, right? Real wage growth has been stagnant. Higher interest rates are really impossible, right? When you have that much debt, you can't raise interest rates. Chris, you're next up on the meeting. Thank you. And higher interest rates, are really impossible, and they're really impossible for us at this point going forward. Housing affordability is getting more and more difficult. Stock prices are high, fueled by cheap money and record levels of debt. That's where we're at, and it makes growth hard. Debt is a drag on growth, right? And you can only get rid of debt through growth, right? The last time we had surpluses were in the late 1990s. And the economy was just cooking so hot, we were putting out surpluses, but our debt was so much lower. It's going to be really hard to get back in that place and have growth at a point where we have any chance of paying down our debt. And if that's not happening, interest rates have to stay low, because if interest rates go up, then we have even higher payments and we go into debt even faster. So anybody who's saying, hey, interest rates have to go up, I think you're wrong. I think interest rates will continue to go down. You can see what flat for Japan. Their home prices have been up for a very long time. And at the time, this is 2016, I suggested that maybe 2.5% mortgages were in our future. I think we're pretty close to there right now. And I also pointed out that Japan is now into 1.35 to 1.7. I don't think that's this crisis, but I do think it's the next crisis, and there will be a next crisis. And I think that's, interest rates in the ones are in our future. Good time to be in the mortgage business, but flat is the new black, right? Not high growth. And, you know, even Warren Buffett back in 2016 was saying, hey, 2% overall growth is about 1.2% per capita growth. It's okay. It's okay unless you ever want to get out of debt, because to get out of debt, I think we need, well, the last time I looked, which was probably in 2016, we needed 4% GDP growth to have any chance of ever tackling our debt. The other big thing that I wanted people to understand, because I think this is going to accelerate and has a lot of impacts, and for us as real estate investors is really important to understand, because it should guide where we invest and how we think about investing, right? And that's automation. So there's 3,144 counties in the United States. 3 out of 5, and remember these slides are from 2016, sorry, they're not updated. 3 out of 5 counties, so, you know, pretty high percentage, 60% of those counties saw more businesses close than open from 2010 to 2014, right? Only a quarter of all counties added business establishments at the same rate as the national economy. 20 counties alone generated half of the country's new business establishment. So you think about that, that's really 20 out of 3,144 counties generated half of the new business. That's a map. This is half of the job growth, which is a little different than half of the new business. Half of the job growth happened in 73 counties, a little more broad-based. But that's, you know, if you're thinking about the US as a whole, that's a pretty ugly picture, right? So we've got Seattle, Portland, San Francisco, LA, Austin, Phoenix, you know, Austin is one of these, Miami, right? Like it's just a handful of places. And I'm showing my lack of geography there. I should know which one of those is Austin. Now compare that. And again, remember this was to 2016. I last gave this presentation just after the presidential election. Compare that to this map. And what's crazy is literally all but like 2 of the red dots here voted for Clinton, and pretty much all of the places that we didn't see growth voted for Trump, right? We have a tale of 2 economies. Most of the United States is hurting, and hurting bad. And, you know, and we've got a handful of places that are doing really well. And, you know, after I saw that chart, it was like so obvious to me why, you know, people will, in so much of the country wanted change. And, you know, William Gibson is one of my favorite science fiction writers. And one of my favorite quotes of his is, "The future is already here. It's just not very evenly distributed." And especially for those of us in the Bay Area and California, right? It's something we need to remember, that most of the country does not look or feel the way we look or feel right now. And unfortunately, there's a storyline that goes along with that that says we need to bring manufacturing back. And in 2016, US manufacturing output was at an all-time high. Like, let that settle in. Like, we need to bring manufacturing back, but manufacturing was at an all-time high. What was wrong is US manufacturing employment was lower than it was in the 1940s. So there's your thing. And here's the deal. Only about 25% of manufacturing job loss was due to globalization. The primary cause was technology and automation, right? Those of us in Silicon Valley building software, building solutions, right? We are making things more efficient. And if you think about utopia, if you think about where we want to go, like, shoot, there's a future where we don't need anybody to work. And that's not a future we're talking about as a country. And unfortunately, that is a future that parts of the country are feeling because they're not needed anymore. And it's causing real social problems. And we've got to figure this out. But we're not going to bring that's attacking China is not going to bring that back. There may be other issues with China. I'm not going to go down that path, but it's technology and automation. And I think we should stay on the technology and automation track. So don't get me wrong as saying, oh my gosh, technology and automation is bad. I think technology and automation is great, right? And you can see that here where, payroll automation software and software really started to become a thing right here in the late 60s. And ever since then, real wages have been flat, but productivity has continued. Wages and productivity separated. And this is all about technology, in my opinion. And what we have to remember, though, is that while wages have been flat, our standard of living continues to go up, right? And that's continued to do very well. I think it's really hard thing to chart or get around. But if you look at personal consumption expenditures per household and what you get for your dollars spent, right? It's continued right up, whereas income has been flat. So, automation, globalization, and all of these things have led to incredibly better standards of living. And we need to remember that piece when we talk about the lack of wage growth, right? It's okay that those two things have separated to a degree, and not that we don't need to see some changes and other things, and there aren't people hurting. I'm not suggesting that at all. But I don't think we're having the right conversations or a full enough conversation about those problems on either political side. So that was number 2 most important thing in 2016 that I thought was important for investors to think about, because where you're going to invest, right? Look at that map of the country and think about where you're going to put your money. Are those places that are going to grow? Are they going to do well? Are they going to be impacted by automation? You need to be thinking about that as you make your investments and decide where to put your money. The third thing that I think was really important for people to understand is this concept of black swans. The internet was a black swan, right? Look what it did to retail and small business and the rest with Amazon and et cetera. So not all black swans are black or bad, right? A lot of us enjoy getting stuff in 2 days to our house. Not 2 days lately, but at one point. I basically made the point that, we're probably not done with black swans, right? Terrorism, weapons of mass destruction, automation, security threats, cybersecurity threats, quarantine, pandemics, right? And this is slides from 2016. And I basically said at the time, listen, what you have to understand is that when the next pandemic hits, I didn't know pandemic at the time, when the next black swan hits, right? Janet Yellen, who was, Fed chair at the time, is going to pull out her SJREI and shrink that black swan to a little baby cygnet, right? What we learned in 2000 and in 2008 was that you throw money at these things and it helps you get them through them faster, right? And we made some mistakes in 2008. They let too much inventory come on the market. Prices went too low, right? Created a lot of opportunity for us. I'm sure there's some folks in the room that did quite well and like to see that happen again. It won't. We can talk more about that. But we do learn a little bit from each of these things. And so that was my take in 2016, right? Debt is a drag on growth. Automation is going to have major impacts. And next time there's a crisis, the Fed's going to deploy their SJREI. So we're jumping back in and we're coming back to today. Again, my all debt bubble, right? Like these things this is not healthy growth debt, including corporate debt, which everybody's like, oh, corporates, they're so great. They have so much cash. They also have a lot of debt. So instead of another bubble though, right, we got something a little different this time. COVID-19, which is more deflationary than it is, a bubble of like prices coming way down, right? So it's a deflationary in that, you know, people are staying home, they're not spending as much money, right? The popular memes today are about, wow, I've got so much more money in my bank account, not going out to eat, not going to Starbucks, not doing all these things I used to do. But that means all that money wasn't spent out in the economy, which is incredibly deflationary. And we don't know what the losses will be yet. I think it'll be a few years before we really have even a good guess of what this looks like. It's pretty big so far. I pretty much no question in my mind it will be the losses will be larger than the housing bubble. So when you're facing this and you're facing like a deflationary thing, and you know, what do you do, right? So you think about, you know, you're the Fed chair, you're the president of the United States. What do you do, right? How do you attack this problem? And there's basically 4 possibilities. I stole this from Ray Dalio's Changing World Order, which is an interesting read. And one of them is austerity, right? Just suck it up, buttercup. It's deflationary, it's painful, you know, yeah, the economy sucks. You just deal, you know, people lose assets, whatever, you let it go. And you don't do anything. You don't throw any money at it. You don't do anything. That's super painful and super hard. And I think we'd vote everybody out of office that went this way, despite the fact that I think it does have some value. It's really hard, right? The good thing about austerity is when you're through austerity and on the other side, you really have set yourself up for amazing growth, which isn't as true, especially with the one that we're doing. The next possibility is debt defaults and restructuring. At the end of the day, though, that's painful for both the borrowers and the creditors, right? You know, the way that typically works is something like foreclosure. You lose your house, borrower and creditor. I now have to sell this house for less than I was owed on it, and I lose everybody loses, right? So not a very popular path to go down. Wealth redistribution, right? Now we're going to go take money from these folks and give it to these folks, and that's how we're going to solve this problem, right? We're going to see some of that, right? Especially at the state and county and local levels. We even have, you know, states like Nevada that constitutionally they can't have an income tax. They're talking about a constitutional amendment to add an income tax, right? I don't think it'll happen, but like, you know, you lose this much revenue because, you know, especially a state like Nevada lives off, you know, sales tax revenue and casino revenue and all that. It's a big hit. How do you pay for police and fire and all the other things that the government has to do? So we're going to see some taxes, especially at the state and local level. At the federal level, the primary thing we're going to do is print money and devalue it. And I'll talk a little bit more about that. But let me first just make this clear. This is not a political thing, right? Nancy Pelosi not acting as the most expensive course. So we need to have Mitch McConnell. We need to have the American people's backs. Federal Reserve Jerome Powell, right? Jeremy Powell. We're not going to run out of ammunition, right? Like, yeah, I understand right now there's some differences of opinion. You know, the Democrats were asking $3 billion. I think they're thinking something 2.2 now. The president just came out in 1.8. The Republicans and the Senate are saying 1.8 is too much. Jeremy Powell is saying, hey, not spending right now is a mistake. You know, come on, Republican senators, get on it. So there is some disagreement right now. And I think the reason there's some disagreement right now is because the first round was fairly successful. Things feel okay, right? House prices are up, economy's kind of okay. We haven't really felt all the knock-on effects of all the small businesses out of business yet and the rest. But I think we're going to feel some more shocks here, and more money is going to come. As Jeremy Powell said, additional fiscal support would be costly but worth it. Bernanke, or was it Greenspan? I don't remember now, suggested throwing money out of helicopters if necessary. Right. So this is where we're at. Right. And the reason we go down the printing money and devaluing it is it seems good rather than bad because most people, it helps. Right. It relieves the debt squeeze, PPP, the extra $600, all that stuff is part of this. And, you know, who's really getting harmed? Right. We just printed more money and gave it to people. Right. But who suffers for that? Right. at least initially. And in most cases, it causes assets to go up into the depreciating the currency, right? Sound like housing right now in a lot of places. So here's, what we're in right now is what's called reflation. And reflation is, one of the things I hear all the time is like, we print all this money, it's going to be incredibly inflationary. We're going to have this huge wave of inflation, right? Everybody's talking about, well, next comes the inflation. And here's the thing, COVID itself is so deflationary, right? That we can do a lot of reflation, a lot of inflationary things, and it'll just bring us back to the status quo, right? We'd have to do even more for it to become inflationary. So just think about, before any of these things can become inflationary, they have to fully offset the economic impacts of COVID. Like, look at the airline industry, look at the travel industry, like, until all of those things are kind of offset. Doesn't mean, inflation's a weird thing. It doesn't all show up in one place. It's not a friend of mine said, it's not an event, right? It's all these little things. Like, we've seen incredible inflation in healthcare and in education where we haven't seen it necessarily in other things. So we will see it in some places, like we're seeing in housing right now. And the Fed has lots of ways that they've gone over this, right? Lower interest rates. It started in July 2019, buying financial assets. At first it was treasuries and high quality debt like mortgage-backed securities. They ended up buying corporate debt. They bought Apple debt, right? Like, does Apple really need the Fed buying their debt? I don't know, but they did. And all kinds of lending programs, like, these slides can be available. Go look up all these programs. It's crazy. All the stuff that was put into the economy, and not millions of dollars, not billions of dollars, trillions of dollars, right? And at the same time, they relaxed regulatory requirements. For example, allowing banks to dip into reserves for lending, right? To put more money into the economy to try to stimulate the economy. And finally, the big one, right? Like the CARES Act, the PPP, the $600, and what we're back talking about now. I think the Senate's working on a $500 billion bill. There's the president, the House, and the Senate all have separate things going. And at some point, those will come together. But that's monetizing direct fiscal stimulus. So that is our government saying, we're going to go spend money. But guess what? They don't have that money, right? Our government's in debt. They have no more money. So what they do instead is they create treasuries. They sell those treasuries to the Fed. The Fed creates money out of thin air to buy those treasuries, and voila, we've sent money out to folks. And I already talked a bit about inflation, and there is a risk at some point, if you do too much of this, it becomes inflationary, right? But you have to fully offset the other. And whenever you have reflation, you have misallocations of capital, right? The government's just not very good at how to do this, right? Think about the $600 a month. It helped a lot of families out, but I have a lot of friends who own small businesses that couldn't get folks to come back to work just as their business was being allowed to open because people were getting more money on unemployment. And, so that small business technically is supposed to report that that person was unwilling to come back to unemployment, then they lose their unemployment. But those folks were like, if you do that, like, I'm going to come after your mother, right? Like, it was ugly for small business owners. So we're just not very good at like how to allocate this capital, how to put it out, right? Lots of stories about the PPP money going to people that shouldn't have and people that should have, right? So, and think back in 2008, right? All the talk was about the banks that are too big to fail and we have to fix that. But every single one of those banks got bigger and most of the small banks went away. So we did exactly the opposite of what we said the problem was. And we tend to prop up failing companies, stock buybacks rather than business expansion, right? The way to get the economy really going is to get businesses to expand, but instead we give them money that they use to buy their own stock and push their stock price up, right? It's not, so lots of misallocations of capital. Bottom line, there's winners and losers. If you pay attention, you can be on the winning side of this trade, right? It's really easy to end up on the losing side. And every single time we go through this, the wealth gap increases. And that's a lot of also what's going on in this country right now that's not good, because these things create incredible opportunities if you have wealth, and also can really set you back if you don't. Jeremy Powell's 40% of US households earning less than $40,000 a year lost their job, right? And if you look at any of the stats on most of the folks in the higher income haven't really had much income hit. The folks at the low end have. What does COVID mean for real estate? I think everybody kind of gets this at this point, right? Like, we're seeing moves from really dense areas to less dense areas. Desire for hard assets. People want a nicer home. People are going, oh my gosh, these 5-bedroom McMansions out wherever don't make sense. And 2 of the bedrooms are his and her offices, right? So now suddenly, like, 5-bedroom McMansions are in demand. Like, there's definitely some things that have changed there. On the supply side, we still have a lot of people out of work, a lot of unemployment. Some of those folks aren't going to understand their options around forbearance, et cetera, and they're going to lose their houses. We thought early on short-term rentals were going to be a problem. That seems to have sorted itself out pretty well. Working from home, office, retail, some of these other restaurant, lodging. Lori mentioned she got a good deal early on, right? There is some opportunity in all of this as well. And disruption, I think this continues to see there, right? Vacant homes are easy to sell. The iBuyers all exited and they went, wait a second, this is perfect for us. We're back in, right? Because they buy the house, you move out, and then they put it on the market vacant. And it's actually a perfect time for them to grow. So what about foreclosures? The other big question everybody asks me. And, we have started to see some foreclosures come back, really September 1. There was a trickle kind of all along, but we're talking in the 5 states we track. It wasn't unusual to see 5 or 10 a day across 5 states. It's coming up a little bit right now. I expect there's an awful lot of foreclosures that were in the pipeline. And I mean, awful lot, not in the sense of 2008 to 2013, but versus the past few years, there's been quite a few in the pipeline that have been pushed out. And like in California, that are getting pushed out, you can only postpone a foreclosure for 1 year, and then you need to have a sale. And so a lot of those are coming up against that timeline now. And I expect we will see, early on I used a wave. I don't think it'll be a wave, but we are going to see some foreclosure activity. And there's possibility with this SB 1079, which I'm not going to go into. You can go to community.propertyradar.com and read about that, that we may see the banks try to push stuff through before the end of the year. So there could be a little bounce. We're going to have to see how that plays out. The banks have to weigh that out with, the negative press of pushing people out of their homes, in COVID. So yeah, it's a little hard to say. Now, what about foreclosures? And most of those foreclosures, folks haven't made a payment in 2+ years at this point, right? So there's really not much possibility of them coming back and making payments that, they need to get cleared up. How they get cleared up, when they get cleared up, still a little unclear. We are seeing more come through. I think we'll see even more probably towards the end of the year. Okay, what about the foreclosures due to COVID-19? The most important thing that people need to know on that is the foreclosure process took a long time pre-2008-9, and it takes even longer now, right? In most states, it's a year plus. In a lot of states, it's 3, 4, 5 years to go through the foreclosure process. There's also was a lot of opportunity around forbearance and the rest, and I think we'll see other relief to these folks. So, anybody who's talking about 2008, 2010, 9, whatever foreclosures out of COVID-19, they don't understand the current regulatory framework. It's not going to happen. In 2009, the banks went from forcing banks to get rid of bad assets and get them off their books as fast as possible to keeping homeowners in their homes as long as possible. And that's still true today. So some areas will be harder hit than others. I think we will see some pockets of foreclosure, more so than in other areas. And, I definitely expect we're going to have COVID-19 foreclosures. There's no question. When will those start? Probably mid next year. Will be the first stories of people who had a job loss due to COVID actually losing their home. That varies a little bit by state. I'm kind of gearing this more towards California. Arizona has always been a little more aggressive in their foreclosure laws, a little faster. The foreclosure process a little faster, so might happen a little sooner there. But I don't think we'll see much until next year. And for any of those of you buying foreclosures at the trustee sale auctions in California, if you don't know about SB 1079, you haven't read up on that, you need to, because I'm not sure you're going to want to buy after January 1st. And that's really hard for me to say because, we've been providing software and data to folks in that business for a long time. A lot of my friends are in that business. I got my start in that business, and it's just a disaster of a law, but we won't go into that here. So here's the thing. Black swans are not a one-time event. We had a pretty good run from 2008 to 2020, right? 12 years was a pretty long run. Think about the previous one being 2000. We had crisis back in the early 80s. Like 10 years is 5 to 10 years is a more typical cycle. Like we got a good run here. But there always will be another one, right? And if you look at what happened in 2000, what happened in 2005, what happened this time, right? You'll start to see patterns. And the patterns are faster and larger responses by fiscal and monetary policy leaders. And that's what I expect will happen next time. And so, you need to be careful, but, this is going to be a continuing cycle, and there's no reason to get caught by it. Michelle, so a gal came out, wrote a book, and I should have the title of the book here and her name. And she said, hey, look, some of these things really aren't black swans. Black swans are unexpected things that you can't predict. And you know what? A pandemic was predictable. Lots of people, Bill Gates and others, were warning us about a pandemic. It's predictable, and we should be taking action to try to stop these things from happening or be ready for them when they do happen. And so these were her top 10 gray rhinos, but felt like a good thing to think about in terms of what could be next. So I will also say that, we were very fortunate in the US that this wasn't a US only crisis, right? We're the world's reserve currency. If this crisis had been this large and only happened in the US, I don't think we would still be the world's reserve currency, or it would be ending, in the process of ending right now. So that's a pretty big deal. And instead, right, we saw most governments around the world get hit pretty hard and have to throw a lot of stimulus at this. And so now, instead of an all debt bubble, I'm calling it the sovereign debt bubble, because, governments kind of worldwide are so over indebted. But, I'm sure there will be a bigger bubble still. So my advice to you is to get out there, go after it, right? Look at this guy, man, making it happen, climbing pretty much upside down. But notice one other thing about this guy. He's wearing a rope, right? So my advice to you is go out there, get after it, keep these things in mind, keep this crisis cycle in mind, understand that we are, as a society, as a world, certainly as a US government, we're going to continue to throw things at this. There will be winners and losers, but those worried about, kind of Armageddon and the rest, like, it's not impossible, right? Nothing's impossible, but it's unlikely. We still have quite a bit we can throw at these things. And I think we'll throw more at COVID in the days to come. And, but, you know, keep some cash on hand, keep, you know, be thoughtful about how you manage things so that you have some safety net if things go sideways and you're a particular investment, right? Who would have, you know, wasn't that long ago. It was like, we have a worldwide shortage of pilots and now we don't. And it would have been, it's just hard sometimes to pick out who the winners and losers are going to be. So get after it, go make it happen, wear your safety harness. And that's it for me. And I'll turn it over to Aaron. Thanks so much.
I love how quickly you skim through that prediction of a mortgage rate that starts with a 1%. That's
the next crisis. That's not,
hey.
I do think we need another crisis to get into the ones, but I would, I'd definitely bet something interesting, you know, a Krugerrand maybe, since that'll be the, that may be the thing you want in that kind of a situation, or maybe let's go with a gold eagle. But yes. All right, Aaron.
All right. Well, hey, everybody. It is always nice to get to speak with SJREI. It's been a while. And you guys in Northern California always make me run for it a little bit. You guys are the data nerds. I love it. I don't want you to worry about taking notes all in the channel, in the chat. We've already posted where you can find all the charts. You'll see on the screen the QR code as well as the bit.ly link. I'm going to be going over quite a few more slides. I'm going to talk about some marketing myths, the competition up in the San Jose area, 3 strategies you might not even be thinking about that are available, and they're all off market, and it's all going to be using public records. First, let's get into some marketing myths. Back in 2012, where this chart, this little graphic was created, there was a lot of conversation about inbound versus outbound marketing. It was back in the highlight of social media, where everything that you posted, every single one of your friends saw. You had a soapbox and everybody was listening, and it was just the golden age of social media. And the outbound was out. Anything that had to do with direct mail, so not cool. The problem is that, you know, social media was really pitching this concept of a two-way street, that the consumer had access to the small businesses, but things have really changed. Social media has really changed their algorithms. You have to pay for absolutely everything. And actually, it's really swung the other way. Out is back in. And the reality in 2020 is, for those of us in this little chart on the bottom left, you'll see inbound marketing, and the targeting is low. So websites, those of us who've been focusing on search engine optimization for years, or creating content on social media channels, it's not free. For those of us who've participated in this space professionally for a really long time, I can tell you I've spent many resources after the last 15 years developing those channels. It takes a lot of work. And unfortunately, you have the middleman and the algorithms that keep changing, making it even more difficult for you to reach them naturally. They really want you to pay. And then you go over into the inbound and the paid advertising, more along the search engine optimization, your Zillows of the world. Those have also really increased in price, and depending on your category and your market, things are really increasing. And I'll give you an example. I was speaking to an investor last week, and I asked her specifically, because I know that she flips in Sacramento, you know, the iBuyers disappeared, but they're back. Have you noticed an increase in your digital ads, your pay ads? And she's like, yeah, it's doubled. And worse, her branded key terms, her business name has tripled, because they are advertising against them. And Redfin just announced that they were going up in the Sacramento market. So now you're going to have 3 iBuyers competing for those we buy kind of keywords, which is very unfortunate. Now, outbound marketing is sort of the mass media, if you will, the newspapers, the radios, the billboards, TV. Those are really expensive and a little bit harder to target. It's going to get very interesting to watch these as hyper-personalization gets a little bit more interesting. At the Consumer Electronics Show this year, I took the augmented reality track, and VR stuff, and they were talking about professionals going through old movies and being able to digitally replace with consumer preference things inside video. Like if you drink 7-Up, everything in the the TV show that you're watching is going to be 7-Up. I think we're just going to be entering in a very new world. But anyway, outbound, however, in hyper local, hyper targeted marketing is really cost effective and becoming even more important. So direct mail, phone calls, SMS, and door knocking. And then when you figure out how to do that, being able to bring those over into those digital channels because you understand it's hyper focused and you can make it work. There is a lot of noise, and it's not because of just COVID, and it's not because we're in the election season. I'm that guy watching Game of Thrones on TV, playing an embarrassing game on my iPad, and then, of course, texting people on my phone. I'm a triple screener. If you took a marketing course 10 years ago, you'd hear something like, hey, it takes 7 impressions for a consumer to want to do business with you. Marketers are throwing around the number as somewhere around 23 over the last couple years because it is so noisy, and you don't have consumers' undivided attention. It is more critical than ever to have the right signals to reach the consumer. And as Sean said, there are definitely winners and losers. And my goal today is to try to get you closer to that winner side. At PropertyRadar, we talk about the DUCA framework. It's a concept, it's a simple framework where you discover a market, you understand it better than anybody else in the business. You figure out how to connect with that consumer and that prospect. You close those deals, and then you figure out how to insert automation to where you can scale the business. Where we're going to start tonight is just playing with data, and my goal is to make you really good at cooking with criteria. We've got over 200 fields in PropertyRadar. It's always fun to explore, and I work with media almost every day, and it's always fun to hear what sort of they're looking for. It feels like I discover something new every day, because in this business there's so many different ways that you can slice and dice, and I know people who do all of these different things. So it just depends on how you want to approach the business. I love this picture. It was in New York Times, and I had to laugh because this is a picture of me growing up. I was in the back seat of my dad's 1980s car. You've got the Thomas guide next to you, and he had the printout in the front seat of some realtor gave him of the houses that he was going to go see. Luckily, things are really different. Technology has really come a long way, and it's so great when you get to see things and you don't have to be blind. And let's be honest, when you have sheets and tons of data staring you at the face in something that looks like that, you're still blind looking at that. It's so much easier when you're able to see, to help you understand, and we have come a long way. There's a lot of data out there, and we're going to have a conversation real quick about chocolate versus peanut butter. In the conversation, data is the peanut butter. Chocolate is what you bring to the table. So as we sort of play with the data, I really want you to think about how you might play with it and apply it to your business, but it really is important. So if you gave me, if you were an introvert or an extrovert, if you, how much, capital you had to deploy, how much experience you had and how much time you had, and maybe a little bit about your background, I could probably fit you into one of these categories, something that you would really love. If you were an introvert with no money, no time, and I started talking to you about door knocking, I think you'd probably hate life a little bit. There's a lot of fun ways to do it, but it's one of the biggest mistakes I see in the real estate investor business is people get lost in the strategies and they don't realize what you bring to the table is fine. We just have to apply it to a strategy that's going to work for you. Because remember this 1980s commercial where she's randomly walking with peanut butter and they run into each other and they're like, oh my God, you eat it and it's the best thing ever. The magic is when you can combine the peanut butter with the chocolate. So let's focus first on the competition. I want to walk through the flippers and the iBuyers that are in Northern California. Let's first talk about iBuyers. And I know a lot of you in the Bay Area don't necessarily just stay in the Bay Area, and it's why I want to cover this real quick. But in 2019, iBuyers purchased somewhere around 60,000 homes, 8.7 billion. And nationwide, they were just a small fraction of the market. Zillow came to market late last year, and when they enter a market, they don't play around. They come on very hard and very fast. And the fear is complete Wall Street domination. They are no longer just buying and selling properties. It's been very clear, especially with Opendoor submitting the SEC paperwork for their IPO. They're open about, yeah, we're launching all these services. We've got our own agents. We want to do mortgage closing. And then after that, we're going to tackle things like insurance. They're really trying to create this ecosystem to where a consumer, once you touch the brand, you may never leave the ecosystem, not just for the transaction, but maybe for forever. Who knows? So I don't want you to feel like this. It's bad enough with COVID. But I wanted you to see this quote that they put in their SEC filing this month. Our success depends on a high volume of residential real estate transactions through the markets in which we operate. I'll just say now what the iBuyers are really starting to focus on, and I've been following for a couple years now. They are focusing on the down and dirty, and I'll show you what I mean in a second. They are not the same. I equate them more to a wholesaler than really being a flipper. And I only want to bring that up because you might run into a situation where you have a few of them trying to throw the local Main Street investor under the bus. And it really bothers me because what they're doing is not what the majority of the investors I know do. Quite the opposite. So here's an ad that I got on one of my rentals in the Riverside County area. It was beautifully done. They had clearly taken a course in direct mail from home investors. They hit everything. It's got the personalized letter, really short, crisp messaging, the pain points addressed on the right side. You've got Dale Everett over here that I'm pretty sure doesn't exist, but by golly, he's got a local number. Pretty great. The only thing they missed on this was he didn't have like a real email address. I thought that was a really weird thing to miss. I visited the website, and then on the right-hand side of the screen, you see all the digital ads that I started to get. It was pretty interesting, and they've just done a beautiful job. This Sacramento investor that I had mentioned previously had interviewed when Opendoor closed the Sacramento office, she got interviewed with this investor, and they're spending something like $100,000 on this greater Sacramento market every month on digital ads and direct mail. That's what you're up against. It's crazy. So why did I get that mail? It was because I fit their buy box. So what does that mean? You're going to be hearing this term get thrown around in the media, probably moving forward a little bit more. And the buy box is just, what are they interested in buying? And I cover Sacramento because I know several people in the Bay Area, especially when people are getting started and your price point is just very different in the Bay Area. Sacramento is where they tend to go. So this is how to read this. I won't beat this up, but this is all the way to 2019. So in Sacramento, Opendoor started buying first in May of 2017. So at that point in time, December 31st of last year, they had purchased a little bit over 370 homes. Zillow only started October, so they've not even been in the market quite a year yet. And up here, you can see the range. So on average, Opendoor is looking, post 1985, 1,700 square feet. They're looking at 3.2s, and they're looking for under the $400,000 range. And at this point, 10 is not really enough to really create a great sample. But we'll check, at the end of this year, and I'll run this again to see. But Redfin, again, just announced that they are heading into the Sacramento market. And I checked today, they have not bought anything yet, but I'll keep my eye open. One of the links that I give you is this right here. It's what iBuyers have purchased in California. If you're a member of PropertyRadar and you click the link that we posted in the chat, it'll open the criteria, and this will be done for you so you can watch their buy and their sell activity. It's pretty fun because I'm a nerd. But this is the activity, the purchase of the iBuyers, and this is what they sold, the activity, and here are the top 10 markets. So as of now, they're not buying in the San Jose market, anywhere in the Bay Area. They're not even in Central California just yet. They're predominantly in Sacramento and in Southern California markets. But here's what they're doing. They are really focused on the down and dirty and the really easy stuff. They are not doing hoarder homes. They're not doing heavy fixers. They're going to continue to stick to newer. And I think they're going to continue to really focus in on that. So what you really can't tell from this picture is it's going to be more rare that you see anything beyond paint, maybe carpet if you're lucky. But It's terrible. This one they didn't put new handles, but typically what they'll end up doing is they'll go into a house and they'll paint everything, including, 40, 50-year-old cabinets, and then they'll slap on like brushed nickel poles. It cracks me up. So this is really, this is a new one that I pulled in Sacramento, and it just went pending. And it was a really fast turnaround. But there you see the 1986, 3 bed, 3 bath, 1,600 square feet. That's their buy box. Makes sense. This wasn't in Palm Desert. I just pulled this specifically for this presentation. This was in, I think it was El Dorado. Anyway, 1961, 3 bed, 2 bath. Oh, no. Sorry. I have the city wrong. Gosh darn it. I was doing 2 presentations today, but I wanted to just show the condition up here. Look at the poles. They put black ones on this one, but you can tell from the picture that those are really old cabinets. So they don't do anything to the properties, and they're going to be focused on really quick turnarounds. I think this works in a great market. I think it's a hot market. This is going to work. If Sacramento ever experiences a little bit of a softening, they're going to hang out. I'm actually surprised. I'm going to start watching their time on market compared to other investors, and I am going to predict now that theirs hang out a lot more, because a consumer doesn't have the advantage of financing a good amount of repairs in the property. When you're spending close to $500,000 on a home, you don't want to have to spend another $50,000 once you buy it, because that's going to have to come out of pocket. So especially first-time buyers, they don't have that. So in the Sacramento area, this is sort of their wheelhouse. Around 1,700 square feet, 3 bed, 2 bath. The vast majority of what they're buying is single family residences. And around that 400,000 mark really seems to be the sweet spot. That FHA limit is always something that I see they try to stick around, which is really, really important. I have investors that use iBuyers in their business. I know people in Sacramento who purposely go after the homes that they're not going to go after but fit their buy box. So maybe it's a hoarder home, it's a probate. What they'll do is they'll take it down, they'll junk it out, and then they'll go to an iBuyer and they'll sell it to them. They were very scared when they left, probably, and then they came back. So it's a way to fit them in. And if not, and you know that all 3 of them are going to be competing against you now, if you understand the buy box, you can work around them as well. Let's go to the flippers in the San Jose market. We'll get out of Sacramento. iBuyers aren't in your neck of the woods, but what I've done for the rest of the presentation, I've taken where we typically meet in Santa Clara at the hotel, and I built a 5-mile radius. And all the data that I'm pulling here on out is this 5-mile radius, and I just want to show you the number of opportunities based on the data that we pull. So flippers in the last 365 days, here are the number of flips and roughly a map of the majority of where those are happening. You are at a very different price point in your market. Looking at the heat map of the where those flips are happening, you're in the $1 to $2 million range the vast majority of the time. When I looked more into the data, unlike the iBuyers, the flippers are really focusing on closer to a 2,000 square foot home, still the 3.2. But look at the top right, the estimated value. They're really sticking in that $1 to $2 million. The square footage range really varies, but the sweet spot seems to be between the 1,250 and the 1,750 square foot, and the majority is single family residence. So really good to know. If you're just getting started, success leaves clues. You don't need to start completely from scratch. That's what I like about being able to pull this stuff up. You don't have to start all the way over. So why would having this data be great? I know who the players are. I can start finding what they're selling, how they're fixing it up, trying to estimate how much money they're putting into their rehabs, how long it's taking them, and if it looks like they're making money. Really good. So let's take that concept of the buy box and apply it to a few different strategies. Let's say the data we're going after is equity owners. We want to build a strategy on that. And the chocolate, let's assume you're an extrovert, you love people, you're not scared of door knocking. And the peanut butter cup we're putting together is Driving for Dollars Pro. Let's dig in. So in that 5-mile radius, I'm going to pull single family residences. I want to pull that square footage range that we had talked about. I'll make it a little bit bigger since flippers seem to like that 2,000 square foot mark. So we're down to 42,000. Let's go to 3 to 4 bedroom, 2 bath. And let's pull up a list that's 50% equity. So I want owner occupants that have 50% equity. I want the estimated value to be under 2 million. There you've got the owner occupants. And I want to talk to people that are over the age of 65. Why would I want to do that? Well, people who age tend to be net sellers of real estate. Maybe they're looking to downsize. Are they possibly sitting on a ton of equity? And maybe they're looking to move to Florida or someplace where they could pocket a little bit more cash. 2,000. Now, if you were in direct mail, where would you want to stop? I mean, even if I'm going from the owner occupant down to the people age over 65, I could hit that age of 65 and over many, many, many times and be a lot more strategic with follow-up. That's another big mistake that real estate investors make, is we're not following up enough. Here's where those opportunities land. If I look on a map, you're going to know the areas obviously a lot more than I will, but it's cool to sort of see it mapped out where all those opportunities lie. Now, maybe door knocking is not a good idea, but there's a lot of other things you can do. Pulling that list together, you can of course do the direct mail. You can pull those ads into lookalike audiences and maybe do some digital marketing. You can call people. I have real estate investors that do nothing but give good phone, as Tony Alvarez would say. They don't do direct mail, they don't email, they just get on the phone. There's emails or social media. I was playing with the social media thing the other day. I was looking in my neighborhood, pulling one of these lists, and I didn't even know a local rock star here in Riverside lived a block away. Now, if I would have connected with her on Facebook or LinkedIn, for example, and I found out that she was connected to the chamber or the nonprofit community, if I were to door knock or to send a letter, I could send something really targeted to her. By spending a little bit of extra time, I could send her down that sales funnel way faster. Forget 23 touches. I don't have time for that. That's way too expensive. Let's take that that data set and let's look at some other data points that you might not even know is available. Maybe you're really good at construction and you really like old homes. So I just said, hey, I want to find the age of the structure is 75 years or older, and there's over 800. Maybe I only want to talk to homeowners that own the home free and clear. There's over 3,700. Maybe I want to talk to households that have children in the home, almost 2,500. And maybe I only want to send cat postcards to people who give to animal charities. And there's over 175. I just like the thought of being able to send really cute cat postcards that's going to end up on somebody's refrigerator for, months at a time. As far as foreclosures in this data set, there's only 5 in the process anyway. So let's flip the script, and instead of talking to owner occupants, let's talk to landlords, absentee owners that may be tired of the 3 T's, tenants, toilets, and trash. And we're going to match the data of that same data set as far as the property features. So the single family homes, same square footage, beds and baths, and the percentage of equity under the 2 million price point, but we're going to switch it up and only talk to absentee. And there's close to 4,000. Over the age of 65, 300. Now, when you're talking to somebody who's an absentee owner, it's obviously a little bit of a different story. I know investors who have had the opportunity to bid on entire portfolio of properties because they did this right. You're talking to, hopefully, a professional, somebody who's at least a landlord, whether they want to be one or not. You can talk their language a little bit differently, and the pain point might be different. Considering today's age in California, it might be a special letter saying, hey, I was driving for dollars in your neighborhood. I passed by the specific property. I decided to take a picture. It doesn't look like your tenant's taking very good care of it. I don't know if you're paying attention, but the CDC, the eviction moratorium, ends to the end of the year. We've got all this stuff going on about rent control. I just want to make sure you're paying attention. If you need any help, let me know. I'm a fellow real estate investor, and hey, if you're looking to sell, I'd be really interested in talking to you. You've helped them out. You've made it personal. You sent a picture. If you're already, around the neighborhood and you can do that, I mean, how much faster can you drive somebody down a relationship funnel? Hyper-local, hyper-personalized, that's where you can win, because Wall Street cannot scale that. talk about some other ideas and some data that you might not know exist. Let's look at transfers. Let's talk to absentee owners that have owned the property for since 1975. Why would you want to do that? Well, they've probably taken all the depreciation. Maybe they're not thinking about that, and you can have a conversation about tax consequences and maybe some creative financing to where they can carry the paper for you. Talking to landlords that own free and clear, there's 1,200 in this 5-mile radius. Talking to multiple owners or corporations, and out-of-state landlords, 243. I was actually surprised to see that many. What if they haven't been following everything going on in California? Wouldn't that be interesting? So it's our job to figure out ways to touch base with these people, communicate with channels that make sense for all these different people, and make it personal. So let's dig into a few other trends. I am fascinated by ADUs. You've probably been following my work on Forbes.com. I've written about this a lot. I interviewed Senator Wachowski, who is in charge of the bills. I think my favorite moment is I was at CES last year, and I was listening to the LA Department of Transportation talk about their multimodal transportation mode. And on the radio interview I did with the Norris group, I think it was a year ago, I asked him, hey, I'm just curious, in the bill, I only have to be 0.5 miles away from mass transportation. Does that include one of the scooters or the bikes? And he's like, I hadn't thought about that. So, man, this micro living has just taken on a whole new conversation because of California and the affordable housing rules. This is a real thing in LA. Podshare, $50 a night to live in an industrial space with adult bunk beds. I know you're calculating that and you're like, why? I don't know. I can't tell you. One of the reasons I'm really interested in following this brand is look at that final bullet point. The future is access, not ownership. It really plays into this millennial membership syndrome where they don't own anything. It's just having access to things. That's really interesting to me. Then there's common.com. This is somebody up in San Francisco. I've interviewed this company before as well. For $1,600, you get access to a beautiful place that they've curated. And this is really, in my opinion, not shelter. This is a lifestyle. $1,600 is not just rent. It's utilities, cleaning, Wi-Fi, and depending on the model, they can include everything from paper supplies like toilet paper to olive oil. And I'm not kidding. It's pretty crazy. At the Apartment Owners Association last year, I had to laugh because there was one co-owning company that was specializing in the creative market. So they were doing things like installing green screens on the wall. As a former professional actor, I don't know if that's a good decision for you, but I'll leave that up to you. And of course, we've got accessory dwelling units. This has just been really fascinating to watch, and I'm really excited to see some of the extra trends that have come along. A bill that was just signed made it impossible for HOAs to play some of the games that they were playing. I forget the number of the bill, but basically what HOAs were doing was saying, oh, sorry, can't build an HOA because there's a 25% cap on the number of rentals that can be here, and that would count towards the rental cap. So sorry, can't do it. Yep, new bill, totally out. Can't stop you. It's amazing. So just a brief overview if you're not familiar with the concept of an accessory dwelling unit. I know there's quite a few opportunities in the Santa Clara market, but this is all the different ways that they can happen on a property: detached, attached, in a basement, in an attic, above the garage, or actually in the garage, which is called a junior accessory dwelling unit. And new code has really pushed this through to where local jurisdictions have completely lost control, but more important, NIMBYs have lost control. If you're not familiar with that term, it's not in my backyard. The builders like to call them bananas, build absolutely nothing anywhere near anything. And it's just got them out of the conversation to where you should be able to build these with minimal issue. You should be able to go to the local city wherever you're looking at building these, and you should be able to grab an ordinance from the building department. It should be very clear where and what you can build, and sort of see what goodies they have for you, because they really want some of these in some cities, especially cities that are having a hard time with affordable housing. I have what I've created, the method. Just because you can doesn't mean that you will. There are a few ways that a city can stop you, and honestly, it's appropriate. Health and safety is one of them. Utilities, If you look above and there's a big power line, depending on how your utility is structured, if that power line falls and somebody dies, the taxpayer might be the one holding the bag. So you do need to be checking on the utilities, and then historic and environmental areas could be an issue for you. So I don't want you buying something assuming that you're going to be able to buy. You need to do a little bit more homework. So how would I use public records to really dive into that? I talked to several different people that I know, contractors and companies that build accessory dwelling units, and the majority gave me a formula that I can work in the Santa Clara market. So we'll take the same single family zoned lots. I'm going to go down to a 1-story. I only want to look at properties with a 1-story. I want to look at where the property itself, the square footage is under 2,500 square feet, but where the lot is over 7,000 square feet. And I know it depends on where, you know, the situation, how the house is situated, but that gives me a little bit of room to play. If I can't convert the garage, maybe I can create something attached or maybe even detached. And I mean, that's a huge list, 26,000 opportunities in that 5-mile radius. I mean, that's a lot. So let's figure out maybe something else we can do. Maybe I want to look at properties that were sold between January of 2009 and the end of 2012, and there's 2,800. Why would I want to talk to them? Are they sitting on a heck of a lot of equity? And for those of you in the mortgage market right now, that's a really good list for refis, pulling money out. Maybe you can talk to them about ADUs. That's a different conversation that mortgage lenders aren't really talking to people about, how to create extra income. So this is where those lots, by the way, are located. Hopefully you can see that. If not, in the link, you can download the presentation. One of the things I really want you to be careful of, appraisals, from what I understand, are still an issue. Remember, a lot of these are being built to hold. So I have funded some of these as part of flips, and I got the feedback is that the appraiser is going to try to find, they're going to try to pull duplexes, and if they can't do that, what they do is just create an average square foot, and the painful reality of that is that you're creating the most expensive square footage crammed into a small space. So when an appraiser does that, it's not valuing that piece of the property, the ADU, appropriately. So that's painful. So I think it'll work its way out eventually, but for now it's still not too fun, but just make sure you keep that in mind. So I just wanted to pull a quick heat map real quick to see if there's any specific areas where it was closer to multifamily, to where maybe they could pull a few more of those comps, maybe that were going to be in the 2 to 4 range. Maybe they would give me a little bit of a bonus or something. Now, if you're really in construction, you know, forget the ADU. Maybe you're thinking about it how I like to think about it too. Maybe you know that the iBuyers and the flippers aren't going to try to tackle something a little bit more difficult. There are, you know, 4,500 2-bedroom 1-bathrooms. There are 4,000 3-bedroom 1-bathrooms. There's 22,000 3-2s. So if you know that building a primary bedroom with a really nice bathroom and a walk-room closet can explode value in the area, that's really good to know. I did end up looking in that 5-mile radius, and there was a little bit over 1,250 duplexes, which is really good. So, you know, obviously I just went through three very different ways to use public records to identify different opportunities. So you've got the owner occupants, the absentee owners, and then sort of that construction angle with the ADUs, or maybe you want to build bedrooms and bathrooms. You're going to be able to find a lot of different opportunities depending on what you're doing. And the goal is to be able to stack these things, or when opportunity comes your way and maybe it doesn't fit you, that's why you join someplace like SJREI. You find somebody who maybe thinks a little bit outside of another box that you don't cover, and maybe work together, who knows. But obviously being able to stack these and seeing opportunity no matter what gets thrown your way is what's pretty powerful. One of my favorite things about PropertyRadar is that, you know, you can decide how you want to get notified of those things. So on that dynamic list, as an example, where the age was 65, I can set that up and just say, hey, anybody who turns 65, I want to be notified. So instead of sending out, I forget how many was in that list, but I think it was several thousand, you know, downloading the list and doing it, you know, every quarter or something. As new people enter that list, I can get an email individually and get leads as they come in, so I can do one at a time. It's not overwhelming, and I don't have to spend a lot of money, which is really fun. So triggers you can really control, and you can see the insights. Some of the charts of what I showed you, when you build these lists, like you see in the top left, when you hit the insights, you can see information on that 860 on that list on the demographic side, but also the property side. So that's where I was pulling some of those charts in previous examples. And then we integrate with over 2,000 Zapier integration. So if you've got a CRM system, actually I've got a list of all of them. Maybe you can, this is just obviously a short few, but some of the people who use PropertyRadar, here's some of the tools that they're integrating with. One of the coolest ones I found that I didn't even know existed was Print Genie, where so somebody turns 65, I can send them a birthday postcard automatically and then have it shoot into my CRM, and I didn't have to do anything. That's crazy. It's a one-off. It's amazing. If you were a member of PropertyRadar and any of the links I created for you in the community, you click on that and it's going to pull all those criteria from the lists I created for you. There's a free 3-day trial. So if you've never played with PropertyRadar and you want to explore those lists, you can do the same thing. Just sign up and click those links and it will work the same way. And with that, we did pretty good. I am good. So we can take some questions.
All right, so I'm coming back online here. That was awesome, and hopefully people enjoyed all of the information. Sean, I'm a little bit scared about what's going to happen in the future. You know, we never like to know that there isn't a, you know, a constant out there that's, you know, the black swan is coming. It's going to be here. But it was good to hear about the reflation and the inflation, because I know a lot of people do have concerns about, you know, us seeing hyperinflation, especially like going from the 13 cents to the $1 trillion loaf of bread. You know, there's a lot of concern with that. So
I really went down that rabbit hole after 2008. Like I just didn't see, I couldn't see, you know, a future that wasn't that. And it was really when I started studying Japan that it became clear that we were a long way from that.
yeah, no, that's good. All right, so far I only see one question here. Can Aaron mention a little bit about Sonoma County market post-fire rebuilding? And if you guys have questions, now's the time to enter them.
It's so funny. I was just, I posted a story on Twitter today about fire insurance. Post-disaster investing, whether it's a hurricane or a fire, you just have to be careful. I know investors that specialize in that, but you just have to really consider what you're about to face and the cost. You might have to bring in crews. It's very expensive. They might not have a place to live. It just really depends on how much damage was done on the fire, but you just can't assume that fire insurance really may be a problem. So you're really going to want to do a lot of research that before you go in, but maybe Sean has some other insights into that too.
You know, there's lots of, the thing about disasters or anything, right? Like, you know, people say, well, geez, what would you invest in right now? And I'm like, well, what's hardest hit? Lodging? You know, it's like, buy fear, sell greed is a good Warren Buffett saying that I think is good. So, you know, I think the disaster thing's interesting. You know, Sonoma in that area, having gotten hit a couple of years in a row, like I think, you know, that's challenging. So, you know, you have to think about, okay, where am I buying? What is that area doing to make themselves more fire resilient? What can I do to build houses that are more fire resilient, right? Some great stories out of there of people that rebuilt completely fire resistant homes that then went through a fire again, but didn't suffer any, you know, the landscaping and stuff suffered damage, but the house itself didn't suffer any damage because they rebuilt fire resistant. So, you know, I think there's opportunities in all of those things. I've also seen some interesting models around people partnering with those homeowners who've maybe, you know, decided to move on, but they still own the lot and they'd like to see some upside and, you know, but also maybe want to see some quick cash. So I think there's a lot of interesting a lot of interesting possibilities there.
Awesome. What is the outlook for apartment investing in the 2021, especially in California with all the new rules? Is this what's the best city to invest in? Probably it should be what state not to invest in.
One thing I think there is that the pendulum's always swinging, and it's swinging pretty hard in a particular direction, anti-landlord right now. One of the projects I want to work on with Aaron is, so there's this thesis out there that, rent is really expensive in California. And I think if you were to ask our state legislatures, is rent expensive in California, they would all say yes. And I would actually argue that's a false narrative, right? So rent as a function of home prices is probably incredibly low in California, which means a low return on investment for landlords. Mm-hmm. So the only way they're going to fix expensive rent, right, is not going to be taking more from landlords, right? Because landlords will just stop, because it's the return on investment's already at the lower end, which California is one of the best places in the world as far as I'm concerned. So I get why, people are willing to accept a lower return here, but there's a bound to that. And I think we need to change the narrative and to say that rent as a function of home prices is actually might be the lowest, and we need to go do the research here, but it might be the lowest in the United States. And if you get, and I think that's a story that no legislator in California has heard. And I think it's really important as us, as investors, as landlords, as property owners, we need to go tell that story, right? They're hearing every day from renters that rent is crushing them and that rent increases are crushing them. But that really is, at the end of the day, a function of home prices. Right. And so, people trying to buy are getting crushed by home prices, right? Now, if you already own, home prices going up is of some benefit, but it's really only a benefit if you want to borrow against it to go spend on, I don't know, motorhome or something, or if you're going to move out of state at some point and take the money with you. But otherwise, home prices going up at this pace don't benefit us as a society. I'm not arguing against them. Realtors, folks that are betting on appreciation, don't panic. I'm not out pitching that, but we've got to address affordable housing, and we can't do that by using other people's money to pay for unaffordable housing.
Well, I think it's more of a narrative that has to make it through the media to get to the legislation. Otherwise, if it's in mainstream and they're hearing it, it's just never, and we're basically gonging and they're not hearing us bang on it. So,
well, I would say our voices are not being heard at all. Exactly. It's not that they're not being heard. I would say, I would challenge you to show me a single person in the investor community who is really standing up in a public way, right? And I'm asking Aaron, that maybe we should take this on. But I would look for others to volunteer. I will help them with data. But I truly think that if we look as rent as a function of home prices, we have the lowest rents in the nation. And I think that's a story that we need to get, told very widespread, because I think it then changes the narrative to say, oh, wait a second, right? There's no more blood to squeeze from this turnip, right?
Exactly. Yep.
There was a question early on about email and phone number data, and yeah, we can append email and phone number to a property.
It's pre-appended, actually. Sorry, yeah, it's pre-appended, but there is an extra fee. There's a fee to export it. It does cost a little extra.
All right, so Sean, comment on any projections for future commercial real estate foreclosure activity.
Yeah, so commercial properties aren't going to suffer some of the fate that residential are. So we may see more opportunity there. A friend of mine runs a foreclosure service in Texas, and when COVID first started, they pretty quickly started to see quite a few commercial foreclosures, and we're expanding. We're going to start competing with my buddy in that market, but so yeah, I think that we might see more happen there. There certainly isn't the protections for the commercial folks that there are for the residential folks. The thing that's tough about commercial foreclosures, though, is that commercial lenders will usually go to great lengths to keep those from becoming foreclosures. So I would say if you're interested in commercial foreclosures, you should start to go get to know the head of commercial lending at your small local banks, right? Because the small local banks do a lot of that lending, and they work pretty hard to clear those things up, even if it's a short sale or something like that, before it actually goes through the foreclosure process. So that's the one challenge of waiting for those as a foreclosure. You might have better luck engaging with those lenders earlier. So look for the boarded up properties, use PropertyRadar, look for the boarded up properties, see who their lender is. If that's a local bank, maybe start talking to that bank about, hey, I'm curious about this property, and, so you guys have a good size loan on it. Is it something that's going to need to get worked out? And I'm interested.
So another avenue too is to watch your Chapter 11 restructures, because I think a lot of the small businesses, they're going to have to close down, do a restructure, try to renegotiate the lease, and the landlord might be wanting to move them out. So that might be another opportunity to buy it from the landlord, because they're done.
Find that property owner and absolutely check that property owner in Pacer, which is a great resource for checking on bankruptcy cases.
Yeah. So do you see any particular asset class getting hit particularly hard with COVID shutdowns?
Most of the talk is about lodging and retail. I'm sitting in a hotel right now, and it's they seem to be doing, okay. They're obviously not excited about the market, but I think a lot of folks are figuring out a way to make things work. Depends a little bit on the county, and some folks hitting harder than others. And you see some folks just saying, I've had enough. That probably was the deal you talked about earlier.
Yes.
It's just like,
so, and our deal was exactly that. This was an older couple that had been in business for 30 plus years, and they were looking to retire. They were looking to sell the business, and then COVID hit at the same time. So essentially it was, they're tired, walk away, and an opportunity for us. And it wasn't that I was looking for a restaurant, but the development opportunity is really what I wanted with the land for, and the restaurant will just carry it.
Yeah. I think for sure. It's just, I think that this is where, kind of the feet on the street, paying attention, right? Like, it's different in every community. I know a couple of businesses in my little community of Truckee have been hit a lot harder than some others. They just maybe weren't in a position. One was, just put a bunch of money into an expansion and didn't leave themselves enough money for running things, right? So, people get over their skis, but it's not usually a whole industry. Like in any industry, one of the interesting things about, business, like when you're first starting out, like it's cash flow and it's really hard, but over time, it's kind of like if you buy a house and you stay in it for a long time, right? Your payment stays fixed if you stay in that 30-year fixed mortgage, and every year it gets cheaper compared to rent, and the price goes up, and like suddenly, like, it takes years, but a lot of folks have been in these businesses for many years, and a lot can happen, and their costs just aren't high. And so it varies so much that I think it's less by industry and more by individual.
I would have to agree. So will the U.S. see negative interest rates?
There's some interesting things around that one, and I'm trying to still wrap my head around it completely. And I definitely don't think so this round. Could we see it the next round? Maybe. There's some interesting issues even here. I thought, you know, we might see that, or see even a little bit more aggressive play on interest rates than we even did. And, you know, there's these knock-on effects that are kind of hard to understand. So like, there's a lot of money in the money markets, right? And they pay very low returns, right? Your money market funds, right? That you maybe have in the bank, and you get a slightly higher return on that than you do just in a deposit account that pays nothing. And, but they're very sensitive to rates. And if rates go any lower, right, people will move their money out of that. Well, when they move their money out of that, that essentially causes a run on that fund, or, you know, a run on the banks, and it removes liquidity. And it may go somewhere else, but it may not go in a good place. And these things can have like these really big knock-on effects. So, you know, one economist I follow, and I would point them out if I remember their name right now, had basically said they can't go any lower on rates because it'll cause an exodus of these funds.
Yeah.
And so, you know, I think there's a really complex set of dynamics around these things. And, you know, so maybe instead of doing that, they do a bunch of the other things that were on my fiscal policy page, right? Mm-hmm. So you can't always rely that we're going to follow the same path like Japan did with negative rates, or, you know, some of these other places. You know, I haven't fully wrapped, I don't know the intricacies well enough to say exactly why, but that was one of the things that was pointed to me as to why maybe not.
So Sean, do you know, people talk about a K recovery, a V-shaped recovery, recovery at all? No, I mean, what do you see?
No, I think this is the wealth gap, right? Every one of these recoveries has been a K-shaped recovery, right? Yeah. At the other side of 1999, at the other side of 2005, 2008, at the other side of this, right? There have been people who've done very well out of it, right? It's been opportunity. And there have been people that have ended up worse off. And, you know, so that is a K-shaped recovery, right? You've got some people doing better and some people doing worse, and that gets exaggerated each time, and the wealth gap continues to grow. And to the degree we don't address that as a society, right, the pendulum swings. And, you know, so all the folks worried about, you know, socialism and communism and all the rest, well, if we keep doing things that have a K-shaped recovery and we don't take care of both sides, yes, you know, we're going to have the pendulum swing so far to the left that it is going to scare the pants out of a lot of people. And the way to stop that from happening is to start addressing the fact that it is a K-shaped recovery, and we gotta figure out how not to leave. You saw that chart I had of the counties around the United States that are doing well and the ones that are struggling. We can't continue down that path and not end up with. And the funniest thing about that, though, is that the folks yelling, you know, for the move to the left are in those areas that are doing really well. And all the folks that are out here that are sucking wind and like really struggling, like they're all like, no, we you know, no socialism, no communism. Like you guys are the ones that need it, right? Like you guys are the ones that should be yelling for it. It's like the whole world's nuts right now. Right.
Well, that's true. So if you had to place money into real estate investing right now, what would you be doing? Long-term, short-term, which states, any states, what strategies, what would you do? Or would you not even be in real estate? Would you do Bitcoin or?
No. Bitcoin's bad technology. So it's just like,
you just got to throw it out there. It's one of the.
No. It's just, if it was, you know, it's a great concept with poor implementation, in my opinion. And if you really talk to really great engineers, they all, I think, agree with that. So anyways, not on Bitcoin. So for me, on the state question, right, like I get it, but how efficient do you need to be, right? I personally, and this is just me personally, I have lots of friends that invest all over the country, and, you know, and they do a great job at it. And I'm not taking anything away from them. For me personally, I started off with a 2-hour rule, 2 hours away from where I live, I would go. And I'm now down to about 25 minutes. So I invest locally. I know those markets well. You know, Tahoe has a pretty low ROI, which is where I'm living these days. And so I'm not getting, you know, huge returns, but they're great properties and they're low management and they serve the needs that I have. And the flips I've done have been really solid. And, you know, this whole have to go halfway across the country, you know, there's a reason that things are a 10 cap. 10% return on investment, and other things are a 4% return on investment, right? The 4% things are better things and more people want them. So you get what you pay for.
Mm-hmm. So going out of state, like to North Carolina, Tennessee, would you not go there? Would you go there? Would you wait till things kind of shake out after the elections?
I would say, you know, I really like investing in thesis, right? So I come up with some sort of thesis that says, you know, I own apartments in a place called Kings Beach, right? And Kings Beach is a low end, it's the lowest end community on Lake Tahoe, right? And I don't get a particularly great cap rate on those properties, but Kings Beach is gentrifying. You know, not mine are all rented to low end, you know, they're some of the most affordable housing in Tahoe, but they just revitalized the whole main drag, right? Folks are coming in, tearing down houses, building newer houses, like that whole neighborhood's changing. There's no way 2 blocks from the beach, that doesn't end up a very valuable piece of property. So it's a thesis that I like that area. I like, you know, you're way better off, you know, buying in Pebble Beach before it's Pebble Beach than you are in some place that has a 10 cap. Like find that thesis. Where's that area that's transforming? Not where can I get a 10% return today? Because guess what? That house is still going to be worth that. And those rents are still going to be that probably 10 years from now, right? All those places that people talk about with that in mind have been that way for 10 years and will be that way for 10 years. They're just, that's not exciting to me. I want to find that place that's transforming, that's changing, that's growing, that, you know, fundamentally is different 5 to 10 years from now. That's, I think, if you're talking medium to long term, right? If you're flipping, go anywhere. There are off-market deals everywhere. They're in San Jose. They're in Sacramento. They're in San Francisco. Like we see people do great deals in all of those places.
Yeah. Thank you. So Aaron, a question for you on the iBuyers. Do you see them moving into the San Jose market, or are we too high priced for them?
You don't fit their buy box.
Yeah.
If we're closer to FHA limits, we could talk, but
Okay.
by the way, I wanted to bring up real quick, keep an eye out on your local 211 and your United Way. We just got randomly here in Riverside County a huge grant, like from a silent partner, and then they got a bunch of CARES Act money. They just gave a landlord like $50,000 here locally to basically as a grant to fill back rent. So it is starting to go directly to businesses. If you're not familiar what 211 is, it's a health and human services hotline. So if you have tenants that's struggling, they'll call and they'll give them everything from rental assistance to utility assistance to food stamps. It's sort of like a one-stop shop. They'll thank you for it. But keep an eye on, Sean brought up the winners and losers conversation. If you're not paying attention, you're probably losing money on the table, leaving money on the table. You're losing money too.
Yeah, if your folks can't make rent, figure out a way to help them, right? Yeah. Like you'll have better tenants. They'll be more likely to pay you. I mean, I had 2 tenants end up in the hospital with COVID, and I told them, look, you guys don't even worry about paying rent. And they did miss 1 month, and the next month they were like, no, we're gonna pay. And I'm like, and they really weren't in a position to pay. And I was like, no. And, you know, they were pretty much begging me to pay rent. So if you take care of folks, they take care of you.
That's true. That's very true. So Aaron, switching topics to the ADU side of things. what have you found as far as lenders loaning money for that? Is it the only way you can get the money is to do a refi on your primary to pull it out? Or are there any lenders out in the field that will do specifically for the ADU addition?
Yeah, more and more hard money lenders are doing it. I know the Norris group, we started really early, but I think we're all starting to see the opportunity. It's because it hasn't gone away and now it's codified, and the cities don't have control. So, and they stripped all those things like having one of the units must be owner occupied. So the private lending space is stepping up. Sean and I did an interview with Doug Duncan of Fannie Mae a couple weeks back, and I asked them the question, you know, is this on your radar? One of the things that I'm really watching for, and it comes up with the builders, is the manufactured home and the plant construction of homes. I think we're going to have to build more robotics into housing production if we're going to get costs down. So I'm really excited about that. The problem is lenders don't like stick-built merged with manufactured home on the same lot. So if you're thinking that's a great idea as well, yeah, you got to be really careful. Just do so much homework before you build anything. I would hate to see you get stuck.
Awesome. Awesome. And then in regards to the appraisals, is there any initiative or organization that's working with appraisers to help them to better value what's being added? I mean,
I actually called the Appraisal Institute about that. It's on their radar. I just think it's so new, and California is leading the way. Sean, what was that? We did an interview, and it was with Doug or somebody, and they're like, "Yeah, it's a California thing. It's not really."
Yeah, it's not a real thing. It's a California thing. Pretty much
Sometimes it's California. We just think everything's about us, and the rest of the United States is like, "Oh, California."
Yeah. Us nasty Californians, we're just always leading things. All right, so then there's another one here for Aaron. Do you see any developers doing ADUs with apartment buildings?
I don't, and that is an opportunity. I think it was up in Portland. There was the concept of somebody dropping houses on the top. They created their own little micro units on top of the roof, which I thought was really interesting. I contacted the Apartment Owners Association about that because there's all these buckets of money and they don't talk. So in LA, for example, they have a fund for retrofitting apartments for seismic activity. So there's a fund there. There's money from the utility to do a lot of things on upgrades for environmentally friendly stuff, low flush toilets, insulation, things like that. And then some of the ADU, the affordable housing money, you just never know until you start going to look, and they don't talk to each other. So there's all these buckets of money lying around, specifically in big cities in the commercial space, and just nobody knows it's there. They're terrible at marketing. Isn't that terrible? They're terrible at giving away money.
Yeah, exactly. It's sitting there. All right. So if somebody adds an ADU to their primary residence, does it trigger a reassessment?
Yes, it's like a pool, unless it's
not reassessment. It's not reassessment. It's added. Yep. So if you put in 100,000 ADU, it'll add 100,000. It won't reassess you at current market value.
Okay, so the house doesn't get reassessed at today's value. It's just going to be adding on what you put into it.
Yes.
But keep in mind, some cities are doing tiny homes. Tiny homes are personal property. So no. So it depends on what you build.
Yeah, it depends on, that's right. If you're bringing in a trailer or something like that, it will get separately assessed as a personal property. Same thing like you can get a property tax bill on an RV or airplane or those kinds of things. That's the way those are looked at. So it depends on what you bring in.
Awesome. All right, last call for any questions for Aaron or Sean.
In that community link I sent you, we'll keep an eye on there if you have any questions about the presentations, or if we missed one of your questions tonight. If you post it there, Sean and I will see it.
Okay. I think that's it, gentlemen. Thank you so much for your time, for all of what you shared. The information is so valuable. I can't wait to share it with everybody again. And this was recorded, so you will receive it in your email along with all the links. Aaron, Sean, thank you so much.
Thanks, Laurie. Thanks for having us.
Have a good night.
All right, everyone. Have a great night. Take care.
Bye-bye.
Bye-bye.